Okay, hello everybody, and welcome to another fun day of more accounting. Yay! All right. So right over here, problem 13-1. On February 2nd, the described below are certain transactions of Edwardson. On February 2nd, the corporation purchased goods from Martin for $70,000, subject to a cash discount terms of 210 net 30. Purchase and accounts payable recorded by the corporation at net amounts after cash discounts. Bad idea. Invoices paid on February 26th. Okay. If you've ever seen any of my videos before, you never taking advantage of discounts, do so at your own peril. I would never do it. Especially if money is tight, I would never take advantage of the discounts unless it was really significant. Okay, so we're asked to go through and to make the journal entries necessary to record these. So on 2.2, I'm going to have inventory. This is going to be recorded at 70,000 at the amount net of the discount. So this is going to be 70,000 times 0.02, which is going to be 1,400, then 70,000 less the 1,400 discount is going to be 68,600. This is going to be accounts payable to record purchase of inventory net of the discount. Then on 2/26, when I go through and pay it, because I did not pay it within the 10-day period, I'm going to have to pay the full amount. So my full amount is going to be $70,000. Now, my accounts payable here is going to be at 68.6. Now, what is this other 1,400? This is going to be purchase discounts lost. And this is really going to be an inventory account. And I don't really care what anybody else says, but I would say that this is an inventory account. Because you should have never recorded it in the first place, but that's my own opinion. So this is to record payment of base report payment of report payment. That's fine. Okay. So that's part one. Part two, on April 1st, the corporation bought a truck from General Motors. Okay, so truck for 50 grand. And they paid cash of 4,000. And the difference, or the 50,000 less the 4,000, was put on a note for the balance of the purchase price. Okay, now it's going to be note payable. Okay, now for this one here, there's going to be no adjusting journal entry, and that's really what is asking down here. However, for this one, because this note will be paid in a year, what I'm going to be doing here on 12/31, I'm going to have interest expense, interest payable. Okay. So the amount of the interest expense is going to be 46,000 times 12% times 9/12, because it's 9/12 because it is April 1st through December 31st. Okay. So 4,140. And there we go. Okay. Number three. Okay, on May 1st, the corporation borrowed $83,000 by signing a $92,000 zero interest bearing note due 1 year from May 1st. Okay, so on 5/1, I'm going to be debiting cash for $83,000. I'm going to be crediting notes payable for $92,000. The difference of these two amounts is going to be a discount on notes payable. for $90,000. Sorry, for $9,000. Okay, so this is going to be to record borrowing from Chicago National Bank. Okay, now what's going to happen is on December 31st, this discounted notes payable really represents interest. So here, I'm going to debit interest expense. I'm going to credit the discount on notes payable. Now, in terms of how much I need to do this for, this is a 1-year note. If it was longer than a year, that's going to be a different deal, but it's a 1-year note. So this is going to be 9,000 times 8/12, okay? And that's going to be May through December, or $6,000. So that's how I go through and record that interest expense. That's my adjusting entry. On August 1st, the board of directors declared a $300,000 cash dividend. So over here, I'm going to have, I'm going to be debiting dividends of $300,000. It's me dividends payable to declare cash dividend. I don't do anything with the date of record. Rather, what I'm going to be doing is doing with the date of payment. So on September 10th, I'm going to be debiting dividends payable, crediting dividends for the $300,000. If you have a question about what is the date of record or what is the date of record, this is really for the transfer agent of a corporation that to notify them which shareholder gets paid. We don't do anything with it though in our books. Okay, so that's what we would go through and do. Okay, and that is problem 13-1, and I'll be right back. Okay, we're back. So problem 13.2 listed below are selected transactions of Schultz department store for the current year ending December 31st. On December 5th, the store received $500 from the C-League players as a deposit to be returned after to be used in stage production that was returned on January 15th. So as of December 5th, or as of the end of the year, this is going to be a customer deposit. Okay. During December, cash sales totaled $798,000, which includes the 5% sales tax that must be remitted to the state by the 15th day of the following month. Okay. So we've got $798,000. This includes 5% sales tax. So this is a sales with tax. If I divide this number by 1.05, which is the sales plus tax, I'm going to get 760,000 sales with no tax. And in terms of making sure that this works, right, what I would do is you're going to take 760, which is the sales without tax, the tax, which is going to be 5%, 38,000. So my sales with tax is 798. So when I go through and record this during December, so to say December 2020, I received cash of 798,000. However, my sales here are only going to be 760. I'm going to have sales taxes payable of 38,000. Okay, so I don't need to do anything else here in terms of any kind of adjusting entries at year end. So I don't need to do anything in terms of adjusting entries. Okay. So on December 10th, the store purchased for cash 3 delivery trucks for $120,000. The trucks were purchased in a state that applies a 5% sales tax. What I don't like about this is that it's not clear as to whether or not that amount includes the sales tax. So, but regardless, your book assumes that it does not. So the amount of cash actually paid. So the 3 delivery trucks are 120 grand. The sales tax is at 5%. So the sales tax, okay, so the total amount that I'm paying for these vehicles is 126,000. And I would be including that tax in my acquisition cost of the vehicles. Okay, so right over here, trucks, 126. Over here, cash for 126. Okay, so the one thing that I would need to do here is that because I use these trucks for a month, if I were to be going through and your book doesn't even have this, you would have to record depreciation. The depreciation, I don't know what the useful life is. I do not know anything on that front. So we're just going to say that we're just going to leave it like this, but I would have to record some sort of depreciation expense. The store determined it will cost $100,000 to restore the area considered a land improvement surrounding one of its store parking lots. When the store is closed in 2 years, Schultz estimates the fair value of the obligation at December 31st is $84,000. Okay, so it's going to close a store in 2 years, and it's going to have an obligation to restore the area around it. So we know that we're going to have to record a liability. However, what we're saying is that the fair value of this liability, meaning what is the value of it today, is $84,000. So the amount I would want to be recording this is at 84. So it's going to be land improvements, 84,000. And then this over here would be a asset retirement obligation of 84,000. This is how your book is doing it. I don't disagree with it. Okay, so I guess my question is on this. What I don't like about this is that, okay, if I have the obligation, so it's important for me, so I know that I have to do this, but if I'm turning around and I'm dumping it within the next 2 years, I would probably want to make sure that I'm amortizing these land improvements or depreciating these land improvements over the next 2 years to show the use of it. So that's the one thing I would want to go through and kind of keep in the back of your mind. You're going to start seeing some things like this when it comes to leases and the like. So just kind of keep that in the back of your mind. But this land improvement would need to be written off over the next 2 years. I have no issue with this at all because if I have an obligation to restore land, I need to put that on my financial statement. So there you go. That was exercise 13, problem 13.1 and 13.2. I look forward to seeing you on the next video. Have a great one.